Well, hello, everyone, and welcome. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar with ProShares. We're very pleased to have ProShares discuss an introduction to leveraged and inverse investing. Now, to start off today, I would like to welcome Troy Goldstein, who is the Executive Director of National Accounts. Troy will be introducing today's presenters and the speakers. So if you would please join me in welcoming, hold on a minute here, I want to make pass controls over to Brendan so that you can go ahead and share your screen. So Brendan, I'm going to make you the presenter, and if all of you would join me in welcoming today's or the Executive Director of National Accounts, Troy Goldstein with ProShares. So thanks for joining us, Troy, and welcome.
Thank you so much, and good afternoon to everybody. Thank you for taking the time with us today. Today we'll be providing an introduction to leverage and inverse investing. I'm Troy Goldstein, as mentioned, Executive Director. I head up National Accounts here at ProShares, and I will be serving as your host today. I spent the majority of my career at UBS holding key distribution roles here in the US, Switzerland, and London. Joining me in today's conversation will be Ben Fulton. Ben Fulton, Managing Director and Head of Tactical Products at ProShares and ProFunds. Mr. Fulton oversees the company's tactical products business, including all of ProShares and ProFunds geared, our leverage and inverse business, our volatility ETFs, and of course, our mutual fund business. Prior to joining ProShares, Mr. Fulton was CEO of Elkhorn Investments, a company he founded in 2013. Previous to that, he was managing director of the global ETF business for Invesco. In that role, he had day-to-day responsibility over the PowerShares ETF business. Mr. Fulton holds a bachelor's degree in business administration management from Taylor University in Indiana, as well as a multitude of securities licenses and FINRA registrations. Also joining me are Leks, Gerlak, and Brendan Cavanaugh. Leks joined ProShares in 2015 as an investment strategist, really focused on portfolio analysis, education, product research and development, and of course the presentation of investment strategies using our company's tactical ETFs. Prior to coming to ProShares, Mr. Gerlak held positions at JP Morgan Private Bank and Vanguard. He earned his bachelor's degree in economics from Haverford College and is a CFA charter member. Brendan, who will finish the end of the presentation, joined ProShares in 2017, bringing with him over a decade of experience in financial services. As our regional vice president and a member of the tactical sales team, Mr. Cavanaugh is responsible for promoting and expanding the use of ProShares and ProFunds, inverse, leveraged, and volatility products to financial advisors across a variety of channels. Prior to joining ProShares, Brendan held key positions at Direction Investments as well as Goldman Sachs. Mr. Cavanaugh earned his bachelor's degree in finance from Fairfield University, is currently a 2019 Level 3 CFA candidate. So with that out of the way, let's go ahead and look at what we're going to cover today. After I provide some opening comments, I'll bring in Ben, Leks, and then Brendan to kind of take us through a discussion of starting with traditional leverage and inverse strategies. Then we'll kind of introduce you to some more modern leverage and inverse investing using ETFs. And finally, we'll go over the in-depth mechanics of how leverage and inverse funds work. Lastly, we will show you how to hedge, how a hedge might behave in different market conditions, so you kind of understand how a hedge works and when to use it. So to kick off, let me try and set the stage with a few opening comments. Obviously, we've experienced many different market conditions over time, and will continue to do so going forward. During the financial crisis, we experienced extreme market conditions and drawdowns, which was followed by, well, one of the longest economic expansions in modern economic history. The ride along the way obviously presented many opportunities as well as challenges for investors. U.S. stocks soared in 2017 with incredible calm. Also, to see the correction that we all experienced in early 2018. While we can't predict what markets will do in the future, we can present a unique set of investment tools that everyone should have in their tool belt that help investors navigate different market conditions, different market environments as we work through this. In an extended bull market, for example, looking at that, investors may want to de-risk their portfolio, but they could face challenges selling equities and incurring capital gains and taxes. Inverse ETFs might just be a way to use as a hedge against having to disrupt your current portfolio without having to touch your current investments. To hedge, you either need to have some cash on hand or be able to raise cash in order to invest, possibly selling out of a position and changing your overall portfolio allocation. Today, we're going to kind of go through different ways to discuss, and we're going to discuss ways to use the universe of leverage and inverse ETFs, which again is quite broad. We cover a range of asset classes, from equities to fixed incomes to currencies to commodities, probably forgetting something, but those are the big ones. When markets trend upward, downward, and volatile, pull back momentarily, and when they present the opportunity to overweight a sector or theme without allocating larger sums of money. So let's go ahead and get started. Let's talk about the very beginning. Investors must have had a way prior to the innovation to manage their portfolios before the modern day ETFs came into play. I'm going to turn it over to Ben Fulton, Managing Director and Head of Tactical Products at ProShares and ProFunds. Ben, how did this all begin? How did advisors hedge portfolios and manage these kinds of risks and market conditions prior to all this innovation? Ben?
Thank you, Troy, and thank you, everyone, for joining us today. Really the idea of being able to either get to leverage or mitigate risk by using leverage or inverse isn't a new concept. It's something that's been around, in fact, since the 1920s. I mean, you had evidence of this, and at that time, you had some actually extreme amount of margin being used in other type of vehicles. And, margin, short selling, the use of options or futures, any of these different type of products have been around for quite a while. In 1993, though, became a very innovative idea that actually a leverage and inverse mutual fund came to market, and there's several providers of that type of product line, including ProShares. But then the actual novelty of the first levered and inverse exchange traded fund was actually pioneered by ProShares in 2006. So we've been part of this story for a long time, and for us have been in the industry in a long time. We've seen some of the different events that have possibly affected investors out there. So traditional leverage and inverse investment have typically either been very hard for a lot of investors to reach, or frankly, they're risky, or sometimes the rules change while investors are holding products. So typically, if you use things like margin accounts or special brokerage approvals or prime brokerage accounts, a significant amount of collateral was required. There could also be additional fees on top of that, not just the margin fees, but it could be extra fees or borrowing costs, and other type of fees could be added in. And when you had these types of events, I think the investors tend to see higher risk. So with traditional short selling, losses are not limited to the amount invested. You could have a margin call above and beyond and have to keep adding money in. Whatever the price of the investment rises to, the investor will have to pay it in order to return the shares when they're acquired. And it's also worth noting with traditional leverage, investors are subject to margin calls. And if the securities drop below a predetermined loan-to-value ratio, these things can happen. So what's the solution? As saying in 2006, ProShares pioneered a new idea that now all of a sudden you could have the advantage of leverage and inverse wrapped into the very convenient package of an ETF. And why is that important? Well, this provided you opportunities to not have to have a margin account. You have no minimums. Investors can buy one share if they desire, or they can, and it had intraday liquidity for investors. The losses were actually limited to the amount that you invested in the product, so at least you can manage that side. And this intraday liquidity, as we talked about, and the lower cost of an inverse and leverage strategy. You knew what the costs were going in. There wasn't a lot of added fees. So this was a great change. And what it did was it provided easy access, or really democratized these type of vehicles. I'm going to hand this now over to Leks, Gerlak, and Leks runs my strategic, is head of strategy for our tactical products, and he's going to go through more of the mechanics of actually how do we get there, how do these products work, and then ways that you might look at implementing. Leks, I'll hand it to you.
Thank you, Ben. Let me start off by introducing how leverage and inverse funds work. Their performance objective is designed to deliver a targeted multiple of a reference benchmark for a single day before fees and expenses. For example, as the benchmark in a leveraged or inverse fund goes up 1%, a conventional index fund would increase 1% with it, while a 2 times leverage fund would increase 2%. And the same type of returns happen on the negative side as well. With a 2 times inverse fund, when the benchmark goes up 1%, the fund goes down 2%. And when the benchmark goes down 1%, the inverse fund goes up 2%. As I mentioned earlier, these examples do not factor in fees and expenses. Now, let's switch gears. Sorry. Yep, so now, while we discussed that ETFs do make leverage and inverse strategies more accessible, we believe investors need to understand them well before using them. These types of ETFs are tools with a whole range of applications. Leveraged long funds can be used in a number of ways, and I'll give a few examples. They can be used to profit from rising markets through directional trades. So if you have strong conviction that the S&P 500, for example, will rise over a certain time frame, a leveraged ETF can be a valuable tool to express your view. These ETFs can also be used to overweight a segment of the market. Let's say a portfolio manager runs a sector rotation strategy and wants to overweight the tech sector. Leverage ETFs can be used in a situation like this to overweight a desired market segment. One of the appeals of leverage ETFs is that they can be used to increase exposure to an area of the market for less cash. An investor may desire a certain amount of exposure to the market, but might not have the luxury of having enough cash on hand for the investment. Using leverage is a way to magnify your exposure for less cash. It can essentially be thought of as an efficient deployment of capital. Now, let's switch gears and look at some uses for inverse funds. They can be used by investors seeking to profit from declining markets through directional trades or to underweight segments of the market. Additionally, inverse ETFs can be a valuable tool in a hedging strategy to offset potential declines in long investments. And we'll look at some hedging examples a little bit later on in the presentation. These are some common applications for leveraged and inverse ETFs. Investors should have a comprehensive understanding of the features, benefits, and risks associated with these funds before using them. Additionally, investors should be prepared to monitor their positions frequently, even as often as daily.
Hey, Leks, so thanks for giving us that high-level overview of investing with leverage and inverse ETFs. But let's dive a little deeper. Let's discuss some of the more fundamental concepts like the daily investment objective, compounding, and rebalancing with these funds.
Sure. Let me start off by reviewing the one-day investment objective. Typically, leverage and inverse ETFs are designed to meet their investment objective or their multiple for a single day only. It's a very important point. Without this one-day objective, gains and losses might result in compounded returns, which could cause the fund's exposure to its benchmark to float. To maintain their investment objectives, leverage and inverse funds rebalance their exposure to their underlying benchmarks each day by trimming or adding to their positions. Returns for periods longer than a day may not, and actually are not designed to, equal the fund's stated multiple times the benchmark's cumulative return for the period. The market environment and volatility can impact performance for periods longer than a day, and we'll take a look at this in the next slide. So now that we've covered the daily objective and portfolio realignment, let's progress to another important concept of leverage and inverse funds, and that's compounding. Typically, compounding is magnified in these types of funds, especially in those with larger multiples or exposure to volatile benchmarks. And while compounding can enhance returns during trending periods, it can also hurt returns in volatile ones. So this is what we'll dig into in a little bit more depth. Let's start at the top of the table and walk through some examples. In the upward trending period shown for this hypothetical 2x leverage fund, as the benchmark goes up 5% each day, it returns 10.25% over 2 days. If you look at the 2x fund returns on the right column, it returns 21% over the same period. So you can see that the 21% return is greater than 20.5%, or 2 times the 10.25% benchmark return. Now, in the downward trending period, that's shown in the middle portion there, while the benchmark loses 5% each day for a total of negative 9.75% over the 2 days, the 2x fund loses 19%. So that's better than negative 19.5%, which is 2 times the negative 9.75% return of the underlying benchmark. Lastly, in the volatile period shown at the bottom, the benchmark gains 5% one day, but then loses 5% the next day. So that causes a compounded loss of 0.25% over the 2 days. The fund, however, loses 1% over the same period. So you can see how compounding negatively impacted returns during a volatile range-bound period. And really, this is why it's so critical for investors to understand these funds and that they're only designed to provide the target return multiple for 1 day. This example here, it's over a short 2-day period. So for investors holding leverage and inverse funds for longer periods of time, it's really important to closely monitor the funds and to consider how the market environment can impact compounding and returns.
Hey, thanks, Leks. Conceptually, it's great to talk about compounding and see how it works, but let's put it into practice a little more. Can you actually take us through some real-world examples and maybe some longer time periods?
Absolutely. Let's take a look at calendar year 2017 and also the first quarter of 2018, which were 2 very different periods for equity behavior and performance. In these graphs, we show the historical return of a hypothetical 3x NASDAQ 100 fund compared to the returns of the NASDAQ 100. I will note the hypothetical 3x NASDAQ 100 fund performance does not include fees or expenses. Starting with the graph on the left, 2017 was a year where U.S. equity returns were strong and volatility was low. So that was an example of a trending market. For the year, the NASDAQ 100 returned 33%, while the hypothetical 3x NASDAQ 100 fund returned 127.7%. So that's a realized multiple of nearly 4 times the NASDAQ 100 index. Now, let's switch gears a little bit and look at the graph and table on the right. Following 2017, equity markets experienced increased volatility in the first quarter of 2018. You can see that the NASDAQ 100 returned a cumulative 3.2% over the 3-month period, while the hypothetical 3x NASDAQ 100 fund returned 5.2%. So there, that's a realized multiple of only 1.6 times the NASDAQ 100 index. Hopefully these two examples help bring to life the impact of compounding. We saw how compounding enhanced returns in the trending environment in 2017 and then hurt returns in the more volatile Q1 2018 period.
Great. And here is the standardized performance for TQQQ. Now, I know that we've covered the daily investment objective and compounding specifically, but Leks, what if investors do want to actually use these funds for periods longer than a day?
Yeah, that's a great question, Brendan. For those investors who want to hold their leverage or inverse ETFs for longer periods than one day, it's important to closely monitor your positions and consider rebalancing when it's appropriate. When you think about rebalancing, at its core, rebalancing is a discipline. It can buffer the negative effects of compounding, but it can also reduce the positive effects. It involves investors increasing or decreasing their positions at predetermined intervals to maintain their desired level of exposure to the benchmark. One thing to be mindful of is that there might be transaction costs or tax consequences associated with rebalancing, so that's one thing to keep in the back of your mind as you're considering this. Additionally, rebalancing may require capital to be available for periods when additional share purchases are required to increase exposure. And finally, as I did mention earlier, even with rebalancing, investors should closely monitor their positions even as frequently as daily. So now that we've covered some considerations for using leverage and inverse ETFs over time, I'd like to introduce two common rebalancing strategies: trigger-based and calendar-based. Trigger-based rebalancing is when you set a trigger for when you want to rebalance. So for example, maybe you want to rebalance when the difference between the fund's return and the benchmark's return becomes greater than 10%. The advantage here of this method is that it may be more attuned to market conditions. However, it might require frequent rebalancing, especially with inverse funds or leveraged funds with volatile benchmarks or larger multiples. Calendar-based rebalancing, on the other hand, is when you set a predetermined interval for rebalancing. This could be weekly, it could be monthly, or quarterly, for example. The advantage of this is that you know exactly when and how often to rebalance. But the disadvantage is that because this doesn't consider market conditions, performance may stray significantly from the benchmark return times the fund multiple during the periods in between rebalancing.
Hey, Leks, can you actually just take us through what the actual steps in the rebalancing process look like?
Sure. When you think about it, rebalancing can be fairly straightforward when we break it down. So here's how you could do it. Starting off with step one, decide when to rebalance. Do you want to use a trigger or calendar-based rebalancing strategy? Step two, calculate the gap between the benchmark's return and the fund's return. In this example, using a hypothetical -2 times fund, we show the benchmark rising 5% and the -2 times fund falling by 10%. So here, the gap that I mentioned is 15%. It's the 5% return of the benchmark minus the -10 return of the fund. Step three, calculate the rebalance trade. The rebalance trade amount is calculated as the initial value of the investment times 1 plus the benchmark return minus the fund's current value. So in this example, the initial value was $100. When you multiply that by 1.05, 1 plus the 5% benchmark return, you get $105. Then you subtract the current value of the fund, which is $90, and you get a $15 rebalance trade. Step four, monitor and repeat the rebalancing if necessary. This is really the process for how an investor could develop a disciplined approach to rebalancing.
Thanks, Leks. Let's switch gears a little bit, though. Our inverse ETFs, they're often used as hedges to protect portfolios against benchmark declines. Let's talk about how some of these hedges may perform in various markets, and just take us through some general examples.
Sure. We often see investors applying hedges to their equity portfolios. And when we look at this slide, let's say an investor had U.S. equity exposure as measured by the S&P 500 index in the fourth quarter of 2018. That's when major U.S. equity indexes fell into correction territory. In this down market example, we compare 100% S&P 500 exposure to a hypothetical portfolio that's 90% S&P 500 and 10% 1x inverse S&P 500. Here, you can see that the hedge not only provided less of a downside, it also helped lower volatility overall. The example we just looked at covered a down market in Q4 2018. In Q1 2019, major U.S. equity indexes rebounded strongly. So in this example, we compare the same two investments during an up market. As you can see, the hedge portfolio provided a bit less return, but again, it also reduced the portfolio's volatility. One note, in both of these hedging examples, the inverse S&P 500 position is hypothetical and does not account for fees and expenses.
Great. And here's the standardized performance for the short S&P 500 ETF. Leks, I really appreciate you going through all this information. It's great to get an in-depth look at how leverage and inverse ETFs can be utilized in different ways and how they make sense in various market conditions. I just want to take a quick step back and just give everyone a little background on who ProShares and ProFunds is actually as a firm. So we bring with us well over 20 years of experience as an asset manager, and we've been at the forefront of the ETF industry since 2006. In addition to our ProFunds mutual fund lineup and our leverage and inverse offering, we do have a strong lineup of strategic funds across several key allocation categories, including dividend growth, thematic, multi-factor, and alternative ETFs. We really continue to focus on bringing both tools and solutions to advisors and clients across the tactical and strategic spectrum, and we focus on managing risk and enhancing returns. One last thank you to all of our speakers. Here's contact information for us at ProShares. So we're here to partner with everyone and assist in any way possible. So for anyone in our audience today, please feel free to reach out to us. Any means of communication on this slide. We hope we were actually able to provide some value here and offer guidance and understanding on how leverage and inverse ETFs work. And just in the next couple of slides, we've included some definitions that everyone may find helpful. Once again, these are going to be available to everyone. And finally, as we wrap things up, here's just a quick reminder about the risks that leverage and inverse funds have. Please be sure to refer to the prospectus for more specific details. And obviously, if anyone would like to download a prospectus, they're available both at ProShares.com and ProFunds.com. On behalf of everyone at ProShares, thank you for joining us today. And we would like to give a special thank you to Interactive Brokers for hosting this webcast.
Well, thank you, gentlemen, and thanks to all from ProShares for today's presentation. Special thanks to Troy Goldstein, Ben Fulton, Leks Gerlak, and Brendan Cavanaugh for today's event. That is going to conclude our session today, but I do want to remind you that today's event has been recorded, and each of you will get a direct link to today's recorded playback. We'll also be sending a PDF copy of these slides. I know there was a lot of information that was covered, so you will get a copy of the slides as well. For those listening via our recording, these slides are also available on the Interactive Brokers website in the webinar section underneath the education menu. So with that, I'd like to thank all of you for your participation here with us today, and you can exit today's session using the X in the upper right-hand corner. Have a great rest of your day, everyone, and thanks so much for your participation today. And by the way, you can all exit today's session using the X in the upper right-hand corner of the screen.